continue down the path of understanding where you grab your P&L from, Adam actually sent in a question. Approximately what proportion of your P&L is derived from what might be described as quasi-arbitrage or casual trades versus taking directional vol or delta risk?
You meant causal trades.
Right. I was like, casual trades.
Just casual slinging.
Don't ask a Peruvian with ESL to read some English in a live show, please.
There you go. So we take no directional risk at all. Full stop. Okay. Arbitrage is a very strong word. I don't think of anything that we do as arbitrage, but we do absolute return.
Right. So relative value, market neutral.
Correct.
Yeah.
Rod, if it's cool, I'd love to grab another question here that came up. It's rewinding back to some of the earliest discussion we had, but Peter Van Amsen was asking about, with the current term structure of, say, VIX, the old, pre-2020 consultant argument may have been there was a volatility risk premium you could harvest. Is there now the potential for an emergence of a sort of volatility term premium that can be harvested?
There's always been a volatility term premium, right? So just to back up a step, right? A lot of people will come with the question, they'll say, well, volatility risk premium looks kind of low in the front of the curve, so why don't you, so say the front of the curve is 10, but this point, 4 years out the curve is 20, so isn't volatility risk premium at, the 4-year point, if realized is 8, isn't it 12 points, right? And what I think any vol guy will say is, or vol girl will say is, volatility risk premium, or in terms of, is a word people throw around a lot, right? There's a risk premium for short-term implied versus realized, right? And that's a risk that you can generate trading short-term options and delta hedging and exposure to short-term options. When you trade a longer-term option, right, the further out the curve you go, gamma is fully fungible. You're just getting a smaller and smaller and smaller amount of gamma exposure to realized vol further out the curve, and more of your risk is driven by vega risk, by changes in the implied volatility of the option, right? And you can imagine you can create a forward volatility position, right, by buying longer dated, selling a little bit of shorter dated, and actually having no gamma, no risk to realized volatility, only risk to implied volatility, right? And of course, that's a directional risk factor. If I buy forward volatility, that's going to tend to go up when the market goes down, and vice versa. So that's an exposure. It's going to have risk premium characteristics. It's not going to, that risk premium won't be reflected in implied versus realized by definition. It gets reflected in what's the shape of the curve relative to, and what does that turn into carry P&L over time, if nothing happens or along different scenario paths, right? And so there is always a term premium concept in vol markets. There's different levels of term premium that you see in different market regimes, depends on flows, who's buying or who's selling vol at different points in the term structure. It's the reason that in the normal state of affairs, term structures are upward sloping, because that's how market charges you carry cost to be long volatility, effectively hedging a risk position.